they're doing, they're customer centric. They know what their customer wants and they're trying to deliver it. Me as a bank lender and trying to work with the individuals on this panel, we try and do what we can within the context of the regulatory frameworks, and rightly so. Credit should be heavily regulated. I'm very comfortable with that. But knowing your position in the market, knowing how to deliver for your client set, being differentiated within that as best you can is clearly the right strategy and what each and individual person on this stage is doing, having had the conversations with them. And within that, you can be as flexible as you can potentially be in the private credit landscape. That is the true unique selling point of private credit compared to all this old banks. You can be flexible, you can do different types of things in your structures, you can take different longer term views, and embracing that and understanding that in the context of what you're doing, but also understanding the risks that come with that, which can be in a relatively illiquid, shall we say, debt instrument. If you're playing in the U.S. market in that large private credit space there, if you're playing in that cov-lite space, no, you should probably be in a relatively liquid instrument. Whereas here, clearly you're maintaining those covenant protections and playing in that environment and operating in that way. That would kind of be my evangelical way of saying, please, make sure you're, not too focused on exponential growth that's clearly apparent, but also making sure you have the right credit strategy. Because at the end of the day, it's debt. It's not equity. You can't, bail out one or two bad ones with some, 10x situation. Typically, you've got to make the entire portfolio work. So.
Thank you so much, David. I think recently I heard Blackstone Steve Schwarzman commenting that if somebody can give you relatively risk-free returns of 12 and 13%, then what else you need in life, right? And on the similar note, BlackRock currently did a survey with the large global insurance players. And more than 2/3 of them were pretty optimistic on this asset class, and they unanimously opined that they want to increase their allocation over the next 12 months in the private credit space. On that note, my next question is to you, Akash and Kaushal. One is that how you are looking at the overall private credit ecosystem in India evolving. What can be done more to strengthen it, right? And what more can be done to raise more domestic institutional capital, and I'm talking about the pension money, the insurance money in India, and even from family offices and HNIs. So if I can start first with Akash.
So I think obviously the industry has come a fairly long way. I mean, some of us have been doing this for over almost a decade or two now, and it's taken various avatars, right? So we've seen what we used to call structured credit in either a bank balance sheet or a NBFC balance sheet. But it's now, I think, found its home in buy-side funds. We call them Cat 2 funds in India. Essentially, these are long-dated, unlevered pools of capital which pool investors together to lend flexible credit, which is where this asset class should be done from, right? And if I were to look at the ecosystem develop, I think not only have the funds and the investors got far more savvier, I think the entire ecosystem made up of lawyers, trustees, the custodians, the asset custodians, valuers, all of them have stepped up the game and looked at this industry to say, how can we get sharper and longer, right? I mean, for example, if I can take our own case in point, I mean, we're probably just about reaching $1 billion in credit, but our level of diligence or the vendors we talk to, their levels of diligence have gone up substantially over the past 3 or 4 years. And just the amount of diligence we do, I can almost say it's private equity-like diligence, but doing it from a credit mindset. So we go through as much detail as a private equity investor would with a debt lens and a domestic regulatory framework of the IBC, and then looking at saying, does this credit make sense or not, right? So I think the industry has come a fairly long way. And I also think that as we evolve, and to the point that Amit made, with every fast-growing industry, there's always going to be talk of, a crisis or a bubble or what have you. But I think the opportunity is structurally there. It's a question of, gradually growing the industry, the right-minded asset managers and the right kind of risk being taken, and obviously being prudent about who you're raising capital from, what their investment objectives are, and so on and so forth, right? As far as getting other players onto the bandwagon, I think from an H&I perspective, they're already significant investors. The numbers that we've looked at, almost $1.5 to $2 billion has been raised from H&Is in India for private credit across the sub-segments over the last 1.5 to 2 years. So the H&Is have in some sense moved ahead of the curve. And obviously the tax change that happened about 1.5 years ago just accelerated that growth. If I were to see other asset or other LPs, if you will, come through just like they are in the, I mean, if you look at the top 5 global asset managers, all of them either have stakes or own insurance businesses, right? And that's the most patient, perennial, long-term pool of capital one can have that matches the asset side deployment of this specific segment. So insurance, pension is critical. I think they will come over time. Today there's a 3% investment regulation from for insurers, but I think as they chase yields, as competition increases, and as the asset class demonstrates value, and that value can be demonstrated once you return capital back. Each of the guys on this table have returned 2, 3, 4 funds. People have seen track record. That will happen. It's a question of when, if not if. So I think, I mean, basic tax changes. So for example, if you want to pool more capital in, I think over the top of my head, 2 points I can think of, Tejesh, is one, harmonize equity and debt investment taxation, right? I mean, it's just the most simple lever. It just facilitates a lot of capital into the debt space. And 2, let a portion of pension or insurance capital be pooled to the industry. One can build in a code of conduct. A lot of the banks were looking at this space. In our recent fundraise, we've got a lot of bank investors before the RBI put in a kind of a framework that prohibits banks from doing this. But there was some chat with SEBI. I think some of us were part of the industry body that went and represented saying, form a code of conduct for asset managers, get the better ones or the ones with better governance to be able to attract capital from banks and large term pools of capital. So I think that will happen. The question is, we need to avoid early speed bumps in the road, if I can use that word. Sorry, I don't know, Kaushal, if you have a view.
Sure. Thanks, Akash. I think largely agree, Akash, with all the points which you made. Maybe on the way the ecosystem is developed in India over the last, I would say, 4 or 5 years in the private credit space, I would maybe highlight 3 critical aspects. One, if you just look at it from, and Amit was also mentioning earlier, if you look at it from context of, just the capital providers, till 5 years back, if you were to, try and raise a rupee fund in India, you perhaps wouldn't be able to raise more than $100, and that would be, on the higher side from just the domestic investors. I think, now you can go and do multiples of that. I think that's a, pretty significant, improvement in the ecosystem as far as private credit is concerned. I think if you look at it from, and the other important part, of course, also is the demand. I think the way the Indian economy has grown, the kind of, the kind of momentum which we are seeing, that has also, kind of enlarged the overall scope of, the kind of, and this is more relevant from a direct lending perspective, which is what we do. I think the scope has gotten enlarged quite significantly. And that's, I think kind of putting a significant amount of momentum on the private credit space. I think the third also the fact that over the last 2-3 years in particular, you will see, as a result of all the factors combined, there are a number of new private credit, setups which are coming in. And, we believe that there is a lot of space in the market. People who are coming up, if they do the right things, there is enough for everyone to, kind of do together. I think that sets up the, the industry for a quite significant, momentum going forward. In context of, how do we bring in more regulated capital into the fold, I think both Amit and Akash has covered it well. I think we just need to keep on doing the right things better. As long as the industry keeps on delivering overall, consistent performance across the years, and we also, have the right benchmarking in terms of, the institutional framework, just the trust factor, someone was mentioning. I think as long as we keep on doing these things correctly, it's a question of, how long does it take for, most of the other regulated capitals to kind of, start flowing in, which is definitely going to happen. I think, the good thing about in the Indian context is that the Indian regulators, are pretty strong. They know what they're doing. They are smart. And I see that, as long as we do the right things, we, kind of create the right interaction with the regulators, there is no reason why, why the capital flow from more regulated sources of capital will, not coming into the field.
Thank you so much, Akash and Kaushal. My next question is for you, Monu. Avishkar has always been an impact investor, a celebrated impact investor. So how you are integrating the performing credit with impact to generate returns? And if I can also ask, because global supply chain financing has been a big theme for you, so how you are looking at that space?
Thanks, Tejesh. So, the private credit opportunity is well recognized in India now. We at Avishkar are tapping into this by using impact as a strategy to deliver returns. So there are times when we get asked, if you had a greater impact, would you lower your return expectations? It's not like that for us. So we've developed a system where impact is a screening criteria for us. And after that, we evaluate the transaction or the deal on pure merit, on a risk and return matrix as you would do any other. So, see, we are an ESG focused fund. We look to invest in companies, SMEs, which have some small exposure to ESG right now, but have the intentionality to strengthen their ESG practices over a period of time, and that's how we add value. I just want to add over here that it's important to understand that ESG and impact are an integrated strategy. Unlike what a lot of people believe, ESG is not just compliance. It's truly value accretive if you do it the right way, right? So, for example, when you invest in a company and help them build their sustainable practices, they could benefit through multiple layers or factors. It could be higher margins, reduced wastage, newer markets, better relationships with shareholders, some of that. Okay, let me walk you through quickly one of the investments that we made, and that may help understand this better. So this company that we invested in is now India's one of the top fruits and vegetable exporters, right? And they work with 5,000 plus farmers to help improve their productivity and increase their farm incomes, etc. Now, the company's been taking a lead in banana exports. Interesting to note that India is the largest producer of banana in the world, with something like a 25-26% share of production, but only less than 1% share of exports. And that's because banana is a tough fruit to handle. Shelf life, the quality that has to go out, it cannot be spotted, all of that, right? So they are taking a lead, and late last year, they flagged off the first shipment of banana exports to Netherlands from India. So it's a historic moment, not just for them, but for the country. And India is looking at it as a $1 billion opportunity to tap on it. And what did the company per se achieve? By working with all the farmers, by building in sustainable practices, they got 30 to 40% premium to their market price, which they're sharing with the farmers. They opened up newer markets for them. They got newer customers, and they reduced wastage, as actually improved their profitability margins. So this is how a truly accretive ESG principles work when you build it in how you do business, and it really truly transforms into your financial performance. So coming to your second question, among the various themes, global supply chains has been one of our something that we are very bullish on. And we look to invest in SMEs, which are in the global supply chain ecosystem of India. So whether they're contributing to exports directly or indirectly, whether it's products or services. So we all have recognized that over the last 2-3 years, exports and manufacturing have become like a big mainstay for India. There's a lot of policy thrust and focus on that. Indian exports are at about $800 billion. And in the last 3 years, they've really gained momentum. So with the shift in global supply chains from China to an alternate source, India has become an important beneficiary. And at home, the PLI has started showing green shoots. As of some data till last year, about 1 lakh crore of investments have been made under PLI. But what's important to note is the multiplier effect on the sales. So with 1 lakh crore of investments, 8 lakh crore of sales have been done. And PLI-linked exports are 3 lakh crores, a 3x multiplier and an 8x. And these will grow further as the projects stabilize, right? So we work with these themes. Right now, the PLI, I think you all may ask, but the PLI is going to all the big boys right now. So, but the trickle-down effect into the SMEs through the vendors and the supply chain is very strong, and that's visible on the ground. So we look to invest in these SMEs, which are now part of the ecosystem supplying through the PLIs, and they are credit starved. And that's the mid-market opportunity in private credit, I think everybody talks of. So the other thing we do in this space is that we not only look at direct exporters, we look at any other ecosystem suppliers and supporters to the exports. Now that could be packaging companies, that could be logistic companies, that could be any other services which are enabling this. And lastly, I just want to conclude by saying that when we support companies who are exporting, we help them build their sustainable practices. We actually clean up consumption, not just in India, we're cleaning up consumptions overseas. So we actually truly amplify the impact that we're trying to do.
Thank you so much. Thank you so much, Monu. My next question is for you, Atul. IQ, EQ administers a lot of large global private credit funds. So any learnings you may want to share from an operations standpoint for the Indian counterparts?
Sure. Thanks for that question, Tejas. We are talking of $100 billion opportunity, right? So obviously it is going to come with its own challenges on the operational front. Now, when we all know that your investors are institutional family offices, and therefore I will touch base with the challenges first, and those are the learnings as well. So, you do a lot of bespoke arrangement, there's a flexibility, the investor wants a different fee structure, a priority payment, and so on and so forth. And when you do investment, again, you have your own nuances attached to it, because you want to see that your distributions are right, you have a projected cash flow which matches with when the amount is actually received, and likewise. So let me take just one example here of direct lending. Now, one would feel that direct lending is relatively easy operationally as compared to your mezzanine debt or a structured debt or a distressed debt, and likewise, where you can do your projection of the cash flow very easily. If there is a chance of any bad debts, you would know it early, and therefore you would know provisioning if you want to do that. But when we work on global fund, we see a lot of challenges even in the direct lending fund. So if this is one case of direct lending, there could be a lot of challenges in infrastructure debt or a real estate debt, and likewise. So which are those challenges that we see? A, you could have a floating interest rate. B, we see the cash interest getting converted into a PIK interest. In the overseas market, you have the direct loan being purchased through a secondary market as well. You could have the amortization of the premium or discount, now which keeps on theoretically changing at each interest frequency depending on whether you have a shortfall of interest, whether you have a default or shortfall on repayment of loan. There could be early interest receipt, there could be early principal repayment, there could be a rollover at the end of the tenure where there could be some restructuring of the loan, and so on and so forth. It just keeps on going. Globally also we see that administrating a loan portfolio is very difficult, because in today's world as well, your agent notices in many cases are still in paper format. So when you deal with those kind of intricacies and challenges, obviously there are learnings. Learning is to make it very easy is that if you overcome all those challenges that I just mentioned, then you will sail through. However, it is not easy, right? Because all that you need is a very good technology platform. Without technology platform, it is very difficult to administer a loan or manage the investor level reporting or accounting of that. B, you need a good mechanism to collect the supports and the documents from your underlying. Now, the example that I gave was of direct lending where, you could have subscribed to a bank would have given it to, say, the underlying could be a consumer finance or a housing loan. I'm talking about the global fund as we frequently see. The level of discipline required at each borrower level, because your bad debt provisioning will start seeing how to measurement of that bad debts depending on the level of compliance at the borrower level is a task by itself, right? So you really need a good mechanism whereby you collect the documents and supporting for the loan, with the help of which you'll be able to administer. And I think lastly, I would say it is better to engage a third party rather than putting your own resources doing the administration of loan or accounting or investor level reporting. The reason I say this is because, as I mentioned, you really need to focus on your flexibility or the structuring of the deal with your investor as well as the investing company. And if you focus on to the non-core areas, it is quite likely, we've seen global funds, it is quite likely that, one can miss the bus. So those are the learnings, I think, for what we see, working on a global fund.
Thank you so much, Atul. So I will move to the next round of queries I have for my panelists. I am cognizant of the time. We have 18, 19 minutes left, so I'll get some quick answers for each one of you. So my question to you is, Rahul, you guys have been, at Trifecta, you have been the pioneers of venture debt in India. On the venture debt side, you raised multiple funds back to back, and primarily your capital has been from the Indian domestic institutions, family offices, HNIs. That way, so what's the secret recipe here? Like, if you don't mind sharing it with others, we can get some cues.
It's a very thick skin. No, I would say that like any other business, one needs to be in the right place at the right time. And I think back in 2015, I think we were in the right place at the right time. I think there was a rising tide of interest in the venture asset class. But I think Indian institutions and families had three concerns. One, I don't think they liked the binary risk of early stage venture. Two, I think they didn't like the fact that the duration of a lot of equity strategies was 10 years. And three, there was always this concern around exit risk. Will I get money back? So I think when we went to them to talk about venture debt as an asset class, we made it a point to address those specific issues of risk profile, duration, and exit. And I think that made the conversation a lot easier because I think they wanted to allocate capital. It's just they needed the right product. So I think some of this comes from, I think, figuring out, what do they want to invest into versus what are we selling? And of course, I think on the demand side, the early stage venture funds had done a great job for 10 years in creating a foundation of borrowers that could absorb credit because the risk profile had changed. So I think Fund 1 was largely on the promise of this is a new asset class. I think Fund 2 was a few years later, we had something to show. And so there was a little bit more track record. And then Fund 3, I guess, just built on Fund 2. And we had some DPI. I think we heard earlier today, DPI is what people care about. I think the good news with, say, even performing credit or venture debt is we generate income every quarter. We distribute that to our investors. So there's real evidence of returns. And so it makes the conversation a lot easier when you go back and say, can you please put in some more capital? So I guess there's no secret sauce other than just, staying disciplined and keeping at it.
Great, thank you so much, Rahul. My next question is for you, Amit. You wear various hats at Edelweiss, right? You are into the performing credit space, real estate, or pure lendings. So what are the finer nuances and differentiators between each of these strategies, if you can throw some more light on these?
So I think, again, for all the strategies, I think the secret sauce you were asking for was actually track record, track record, track record. I don't think there's anything else actually that defines any alternate asset manager. I think the private credit spectrum is a fairly spectrum which is wide. So you have funds raising capital from promising a 13% odd returns to all the way up to high teen returns on the private credit side. So, and I think we as Edelweiss Alternatives manage $4.5 billion across the entire credit spectrum. I think it's very important to understand, so investing is quite well understood. In fact, most of the reporting that I see is on investing, and most of the excitement is about investing, that this is where Edelweiss invested, this is where Baring invested, this is where IFL invested. I think it's also important to understand what is the domestic LP looking to give you money for, because this is a capital which is unlike the previous avatars where it was drawable back at any given point of time, let's say in a mutual fund structure or in a bank structure where they are giving deposits which can be drawn. These are 4 to 5 year locked in capitals. These are capitals which they can't really ask you back. So I think the market as it deepens, and that is where I think the more the number of competition coming in, I think it is actually better for the industry because you are deepening the market. Like for example, a very recent regulatory change of dematting all the AIF units. I think that is a very, very progressive thing because now people can look at it in their demat accounts, these demats, there can be trading. Like we have seen secondary transaction in AIF units. We have sold over $200 million of secondary AIF units over the past couple of years. That is an example of deepening of markets. You are seeing non-convertible debentures being traded between funds. We sold down something to the market, and so the market is beginning to deepen. So I think the LPs will start becoming more cognizant that they have liquidity from outside the market apart from only contributing into the fund. So that is going to lead to a lot of development of the market. On the investing side, I think there are only 3 things which the investee entity is looking from us, or a corporate who actually borrows at non-bank rate or bank plus rates. I think he's looking for 3 things. A, his growth is faster, and I think as an Indian economy, the growth is faster, and sometimes the debt capital from the banking system is not able to basically move at the same speed as which the entrepreneur wants to move. The second is flexible solutions. So he's not looking for inflexible approaches because business is cyclical. When you're talking of 5-year, 7-year horizon funds, you should be able to meet the cyclicality and also offer him flexible solutions around coupon or structuring around equity or variable return. And the third thing is more of a partnership approach that he is looking for. I think what we have realized that it is very impossible, I would say, or very hardly possible for us to make returns unless our clients actually ending up in a healthy position and making actually good returns out of our investment, because debt capital is supposed to enhance equity returns at some form. So I think if all of those 3 objectives are met, there is enough and more amount of capital that we can deploy across a core strategy, performing strategy, special situation strategy.
Thank you so much, Amit. My next question is for you, Kaushal and Akash. How you're looking at the mid-market space as an opportunity, because globally, if you see, the highest amount of private credit is attracted by the mid-market opportunity, right? And how do you see it from a performing credit perspective, because you two champion in that, right? We can start with you, Kaushal, first.
Sure. So I think let me start by saying that, kind of highlighted that mid-market space, to my mind, is the most interesting space in the private credit, market right now. Multiple reasons. Let me start by just saying I think perhaps the most compelling risk-adjusted return strategy, which we are seeing currently. We of course as an institution have been focused on this area for more than 10 years, more than a decade now, and we have done deep work here. We have done extensive data analytics. What we have realized, and it's a very interesting point, is while the mid-market businesses by size are smaller, and to that extent they have more limited access to the public market in terms of capital. But if you look at the mid-market businesses, and especially the top quartile businesses, which by itself would be, I think, would be more than 1,000 corporates. If you compare them to the larger counterparts, they would compare quite favorably in context of any of the matrices. You can talk about the profitability ratios, you can talk about the return on capital, it could be the leverage, it could be interest coverage. They compare pretty favorably with the larger corporates, which means that when we are able to generate a delta IRR or return on the investments which we make on the mid-market space, that comes from a very compelling kind of thesis in terms of the risk-return strategy. I think also, just to kind of highlight the fact that, while mid-market is a very interesting space, one very important aspect of doing this business is that it takes a lot of, patience. It takes some bit of effort and long time period for you to build the right sourcing channels, to understand the risk aspects. I think David was talking about, one needs to be very cognizant about how you structure the transactions, also how you think about post-deal monitoring. So there are a number of intricacies of, doing this business, which comes, with time, and to that extent, people who have kind of spent time doing this over the last decade or so, are pretty well positioned to kind of take the benefit of this space. Just in terms of, I think the opportunity going forward, the opportunity seems to be just growing. Over the last few years, if you look at it, the mid-market business has been more oriented. Some of the sectors, maybe, services or, infra-linked sectors or renewables. But what we have seen over the last few quarters in particular is that the manufacturing space has come up pretty well. And to my mind, over the next 2 to 3 years, the manufacturing demand itself in terms of capital would provide a significant impetus in terms of, how the mid-market, business grows going forward.
Yeah, just to sort of add on, I'll just add a sort of a couple of points to what Kaushal said. I mean, we think of credit as two pillars within performing credit. One is where you're looking at the larger, more structured transactions where you're solving for a specific solution or a flexible capital ask. But the mid-market space for us is equally compelling. And we've looked at it from 3 points of view, right? So 120,000 companies between $50 million and $500 million of revenue where operating leverage is below 3 turns, right? That itself shows that, and this used to be 4 turns maybe pre-COVID, right? So we're seeing a fairly healthy set of balance sheets, diligenceable data, fairly well-run businesses who have long track record, who are now coming to the credit spectrum where access to capital is a constraint, right? So you're solving for a pretty basic need of growth capital, but you can structure fairly effectively and you can really get returns which are easily available because you're solving for an access to capital challenge. The other sort of piece of data is that if you keep out services industries or sort of asset-light industries, like Kaushal said, there's a wide variety of industry diversification available, and you're not specifically doing thematic investments, if you will, and you can really build a portfolio fairly sensibly around the whole mid-market space. And I think all facets of credit protection are available, right? So business assets, cash flows, promoter assets, promoter recourse. You can really build a very sensible credit package without being sort of diverted away from classical old school lending principles. And I think these 3 facets along with the returns make it a very compelling piece, at least for us. And I think investors like that, right? They like to see new businesses, they like to see growth capital trades, and they like to see well-structured transactions within the risk reward that one can really build effectively. So because of these 3 or 4 points, I think the opportunity is compelling, it's large, and within that space, supply of capital continues to be limited.
Thank you so much, Kaushal and Akash. So my next quick question is for you, David and Atul. What are you seeing that how the foreign funds are looking at India? I had asked that question, but what can India do better to increase that foreign inflow of capital in India in the private credit space? What can the regime here do differently to attract more global capital? I may start with you, David, first, and Atul, if you can quickly chip in.
I won't get too preachy. I'll try and make some points, though. There is no syndicated large entry point to get familiar with Indian credit transactions. There just isn't. That exists in other markets. It's very simple for someone to come into a market and see, the rigor, the patient approach, basically everything you'd want to see in order to get comfortable with the debt investment. It's hard to see that. So it's very difficult to attract international capital unless it's patient, unless it's been told the story, and ultimately it's, frankly, going to be done by someone on the ground typically. So I would say take a very patient approach to attracting the international capital, and make sure the most important thing is you sell the story. I mean, it's obvious, as I said earlier, the general trends, But private credit in the country is still relatively new. It's building the track record, selling that on, and saying all the things that people expect from private capital, the sensible way it can be deployed, but ultimately a way that is flexible, exactly what it should do, and selling that story to a bunch of investors that think it's that way, but isn't necessarily sure because they just can't see it.
I think I will have a different perspective here. We do a lot of due diligence on behalf of our client with their prospective investors who are looking to make an investment into the fund. So, if I have to summarize the sort of inquiry that comes from them, they're all related to governance, transparency, independentness, controls and checks. Not just for the fund, but for the fund administrator who could be doing they're providing the fund admin services to them. The kind of flexible arrangement or the bespoke arrangement that we've all been talking about also leads to questions regarding, whether how much is the independent valuation as a fund admin we do, whether there is a proper onboarding process for the investors, AML, KYC, as well as for the vendor. Whether did you have any regulatory, adverse remark, whether the auditors had an adverse remark for, for the fund as well as for us. Whether, are you complying with the timeliness, whether, you have a technology deployed to take care of the transparency or the bespoke reporting that they need. It goes to an extent where one of a very large institutional offshore LP had also inquired that do you have a mechanism whereby you can convert the paper document into a digital document and therefore then let us know about, give us a lot of reporting at a granular level. So there are a variety of kind of questions that come along with it. And, but I mean, if I have to again summarize, it's all about transparency, an ability to read data, an ability to use technology and governance. I think those are the questions I would summarize.
Great, thank you so much, David and Atul. My last question is to you, Monu. And see, there is a saying, and I'm coming to exits, I'm talking about exits. There's always a saying that nobody will give you a sweeter story or a better story than somebody who is trying to borrow money from you, right? And there's also a notion which will say that give me a loan and leave me alone, right? So that brings me to the final question on exit. How you are seeing the exits shaping up right now, how you are trying to prevent defaults, and if there are any lessons learned which will be useful for the industry. So like quick take on this.
So the exits in private credit are a little different from private equity, it's big brother. So what happens, unlike private equity where there is a one-shot exit most of the time, in private credit we see multiple recurring cash flow based repayments. And so that kind of in some way lends some kind of visibility to your exit strategy, though I must say it does not make it any easier. So when we look at exits in private credit, it has to be it's very intense. It has to be a holistic approach, right from client selection to structuring, monitoring. The post-investment monitoring is a very, very important part of this. So in the industry, private credit has existed in some form and manner for the past few years, mostly large structured deals, which were buyouts, leverage deals, or distressed, participated by large funds, domestic and foreign. But in the current avatar, which is the performing credit and these mid-market type of companies, my belief is that the track record is still building. But from whatever track record we have on exits, it's very promising. In the last year or two, two key trends I would say is that one, many funds have exited their investments, credit investments, ahead of maturities. And that reflects good selection. It reflects healthy liquidity with in the corporate balance sheets. And the second is that there is a healthy mix of takeout. So it's either through regular cash flows as per the plan, or through refinancing, or even equity takeouts. So that's the first part. We, as Avishkar, we are very, we again have tightened, or we have very deep processes for managing the entire loan journey. So we're very selective with our origination, and that is coupled with structuring. We do, and like a lot of credit funds, we do a combination of collateralizations, which is promoter guarantees, business assets, cash flow tightening, etc. We are very cognizant of the priority of cash flows, because when things go south, it's your priority that matters. So the other thing we do is that we focus on our portfolio concentrations. We are a sector agnostic fund, thematic, but not sectoral definitions. So we have sectoral caps, and that kind of helps us manage the industry risk. And my key messages or learnings from the credit industry so far is, one, credit is a cyclical business, and we all must be cognizant of that. We are sitting in a buoyant market, and that sometimes make you believe that it will stay like this forever, and that's not the case. So however healthy the corporate balance sheets look right now, one cannot take the eye away from the downside risks and have to mitigate that properly. I think the other key message I want to leave is that do not get swayed by the pressure of investments. Be patient and get the right deal. The worst thing that can happen is if the fund managers or the investment teams start lowering their credit standards in the pressure of liquidity sitting in the funds to make quick disbursements and move on to raise the next fund. So yeah, and of course there's no substitute to detailed due diligence. We all believe in that. You have to go through external, internal validations and tight post-investment monitoring.
No, thank you so much. The last part, as a lawyer, I loved the most, right? You need to do a detailed due diligence so you know to whom to go. And so thank you so much. It brings me to the end of this panel. I have taken liberty from Rajat. He has allowed me a couple of minutes, so I would like to do a quick rapid fire. I'm saying quick rapid fire, actually, that way, and maybe expect a word or two from each one of you, and I can start with Amit, and maybe we can, with Akash, and we can go so on and so forth. So my question to each one of you is that, which is one book or a web series or a movie? I call it as a KMP session, not a key management personal thing, what you know, it's more like a know my panelist, right? So the first question is, what is a book, web series, movie which defines the Indian funds industry actually, or private credit industry the best, which you can share with the audience?
I think that's a tough one for not a voracious reader like me, but one book at least, which is completely nothing to do with the credit industry, but which I think is a matter of thing for the private credit industry, I think will be Atomic Habits. I think we all need to have that atomic habit, the need which she said not to do investment for the pressure of it. I think the industry has to have that habit, and all of us as investment professionals need to build that very strong sense of habit of what we are investing in, be core to our thesis. But I don't know if there's any book I can define for the private credit industry or alternate industry in the night, but genuinely, that's what I would say.
Quick ones, actually, from each one of you.
Book that I think should define us is Same as Ever. It's a fantastic book, but what I'd like one of us to be is the web series Billions. I don't know who can be Bobby Axelrod here, but some of us can try and be him at least, but to have some fun.
For me, Lost in Translation.
The movie, The Big Short, is one of my favorites. It shows how you can missell, you can create bubbles out of good asset classes, and hopefully we are not going to do that with private credit.
I'd say maybe one essential reading is a book called Principles, which I think as managers who are building hopefully long-term franchises, we need guidance, and hopefully we can pick up that from books like that.
I think I'm missing the name of the book, unfortunately, but it's a book about Bayesian approach to doing business in a way you do incremental improvements into your business, and that's what I think the industry has been doing over the last few years. Just forgetting the name of the book, though.
Not an issue.
I think it's a web series called Dumb Money. It's a Netflix series, and it talks about how you get the money. So not particularly for private credit, but generally about investing and how it can go wrong or correct.
Last 1 minute, starting with you, Amit, again, sorry to put you on the spot. One thing, or what you would have been if not the fund manager, right? What you would have been, could have been, should have been, or what you will be, right? If not the fund manager. Quick, one take for us.
I'm a chartered accountant, so maybe an accountant, I guess.
I'd teach kids sports.
I had this question in an internal session 2 weeks ago, and I honestly said unemployed. Because I'm truly doing what I enjoy doing, and I wouldn't really want to do anything else, so I'll go with unemployed. How about that?
So I've been a corporate banker for 25 years before this and jumped into impact investing last year. As of now, I can't see myself doing anything else but this.
Yeah, hopefully, if one has a life after this, which seems like it's going to be pretty tough, but I'd love to be an architect. So.
Philosopher, maybe?
I think I would retire and enjoy my life.
Good one. Thank you so much to each one of you, and that brings to the end of my session. Thank you so much to each one of you for wonderful insights, and thanks to IVCA. It was glad to have all of you here. Yeah, thank you so much.